The problem with the collapse of Silicon Valley Bank is a big problem because it puts pretty much every American bank or every bank in the world now in question. And I think this is a little bit of a dangerous game that capitalism is playing with banks, because every bank fundamentally is vulnerable to a bank run. Every bank is fundamentally vulnerable to a collapse. And that's in fact why we have the Federal Reserve System. So the Federal Reserve System is supposed to prevent a run on banks. It's supposed to prevent a collapse of banks. But sometimes it happens, and I think the art of dealing with this from a regulatory perspective is to let investors suffer for bad investments, but have depositors and every other investor and everybody else who is not directly invested with equity or bonds into a particular bank not suffer. This is the key, because otherwise, what's the point? I mean, if we can't solve the Silicon Valley Bank issue, then we might not need a regulator and the Federal Reserve. All the other stuff is irrelevant. If we can't help this situation, this is a little bit like a call of 9/11 and the police doesn't show up. If they don't show up now and they don't save the financial system from a collapse because the Silicon Valley Bank issues, then quite frankly, we have a much bigger problem. So this is a big test for the financial markets. It's a big test for everybody. For us at Orange Capital Partners, we are obviously we're concerned. We have some runaway money. This is one of the things that one has to always keep in mind, that you need to be able to go elsewhere if need be, and start from scratch. You need some money somewhere hidden, literally hidden, maybe not hidden from authorities. No, that's not the point, but hidden from calamity, so you can restart. So this is kind of the way we think about this financial situation now. So on the one hand, we expect the regulators to save it. On the other hand, we need to be safe enough for us to have enough money to restart somewhere else if everything collapses. There is a nuclear option here. It's always there. Things can collapse. It can become much worse. And this is one of those situations. This is Not Even Wrong podcast. It's March 14, 2023. This is Krim Delco. For the year, we are up 46.4%. The market's up 40 basis points. For the year, we're outperforming by 46.2%. The big story right now is, of course, the macro situation with the financials. We had Silicon Valley Bank collapsing, basically being put into receivership. And what happened there is that the assets and the liabilities just didn't match anymore, which is, to be fair, can happen to any bank. In this particular case, it happened because some of their assets were just bad assets. In other words, their investments were bad. I don't know what exactly happened. I think nobody knows until this whole thing is unraveled. But what typically, there's two big problems that banks face right now. One is maturity risk and the other is credit risk. I think what happened with Silicon Valley Bank is that they invested in bad assets. For example, there's a big slew of private equity and venture capital out there investing in things like ESG or impact investing and that kind of stuff. And a lot of that stuff is literally it's just not profitable enough. So those are bad investments. There's probably some shenanigans going on where, let's say you're a founder, you have your money with Silicon Valley Bank, and then you borrow against your shares in the startup from Silicon Valley Bank. So there's that kind of thing. And then when the startup shares go sour, you're basically left with nothing. And then third, we have the maturity risk, which is that even if Silicon Valley Bank was just doing what most banks are doing, which is buying treasuries with the deposits that they have, then maybe there's maturity risk because treasuries lost a lot of value recently, which puts the concept of risk-free rate in question. Excuse me. So those are the three big vectors that put banks at risk. And let's go through them one by one. So credit risk is just simply you give loans to bad assets. You give loans to, let's say, real estate. You give loans to companies. You give loans to all kinds of projects that are just not worth it. This is the typical risk that banks have. And the way banks should be managing that risk is to spread the risk, to have some sort of credit quality assessment, business assessment, all that kind of stuff. I think I second some of the thoughts that I've seen in the market that the more regional banks, the smaller banks, they're able to take more idiosyncratic risk, which is why are they regional? Well, they know their region better. So if, let's say, if I have a small pulp and paper company in Oregon, then maybe the big money center banks in New York, they're not going to lend me money. They don't know anything about pulp and paper. Plus, I'm not a big company. But the local guy might think, well, you know what? You own some good real estate there. By the way, I know your wife's cousin is rich, so they might help you. I don't know, things like that. So I might help you out with a loan. The local banks have local knowledge when it comes to real estate. That's even more important. So having said all of that, I just think that it's useful to have local banks. I think they serve a purpose to take a little bit more idiosyncratic local risk relative to the big money center banks who are more for large companies, large international corporations, and all that kind of stuff. So the finance industry is segmented into different problems that are attacked by different types of companies. That makes a lot of sense. Now, when sometimes small banks fail, and we had that in the past, the savings and loan bank crisis in Texas, for example, we had issues in 2008, which were also more local, although there we also had big sort of global money center problems. But now, again, we have local problems in Silicon Valley, particularly because there was a lot of froth here because of the whole bubble which happened after COVID and the cheap money, and then all the money went here and all that stuff. I just want to sort of summarize that, because this is not an analysis of Silicon Valley Bank by no means. I haven't done it properly, and it's quite frankly very difficult to do. But what I want to say is that every bank has certain credit risk, and that local banks have a little bit more of that. And I think this is now the conclusion. I think the regulators, they just have to protect depositors. It's absolutely paramount to protect depositors. There could be some predatory depositor hunting and things like that, maybe some corner cases where banks were paying very high interest rate for deposits, then maybe you should punish the depositors for that. But typically banks are there with very normal products and services. And as a depositor, you're not in the business of doing credit analysis and all that. So I think it's fair to protect them. And I've studied the formation of the Federal Reserve quite a bit, and I've come to the conclusion that the only real reason why we have a Federal Reserve, the only legitimate reason why we have a Federal Reserve, is actually to have an insurance for banks. I think it's okay to have an insurance for banks, because you can have a contagion effect where one bank does bad business and everybody else collapses because nobody else trusts anybody else, and you want to prevent that. And if you have an insurance policy on top of all the banks, I think that helps the economy. I think that is better for everybody else, even though it creates some moral hazard and all of these things. But I think from an economics perspective, and I don't know how the Austrian economists think about this, but I think that the insurance policy that you can draw on a bank in a system like, let's say, that we have with the Federal Reserve is a good thing. And I think it's the job of the regulators now, the job of the finance, the Treasury and the regulators and the Fed, to save this situation in such a way. The ideal way to save this is to not protect investors, but protect the depositors and make the plumbing of the financial system work. This is the key, because you want the financial system to continue operating. That's fundamentally important. Otherwise, everybody else will suffer, and that's not okay. I think when it comes to Silicon Valley Bank, Signature Bank, and some of the other banks, yes, there's lots of shenanigans going on. I think, like I said, the three main reasons: one is bad loans to businesses, one is sort of this hanky-panky between founders that have their money with a bank, and then they take loans against the shares of the company. There's definitely have been made some bad decisions, and I think banks shouldn't be in the business of investing in. Banks should not be in the business of investing in startups in any which way, even by lending against shares, because that's an investment too. I think startup investing is way, way too risky, in a sense that you just don't know. Even the startup founders, even the VCs don't know. The VCs spread all of their investments across many, many companies because they don't even know who's going to succeed. So who are you as a bank to know that? So to give loans against shares of startups is very, very dangerous. You can do it maybe for a little bit, but you know, like even with our fund, we keep our leverage between 10 and 20%. We absolutely cap it at 25%. We never go above that. which is relatively high given the high volatility in the market, but we have capped it recently to more, we're about 14% right now. And quite frankly, it's a little bit nerve-wracking to even have that much leverage. So what I say is, you can have maybe 20 cents on the dollar in loans. That's okay, because then you can technically have an 80% drawdown and still be okay as a bank. So that's kind of tolerable maybe, but I would say as a startup, even that, I would say 5 cents on the dollar, maybe max. I mean, you actually, it's not inconceivable to have everything wiped out in a startup. So as a bank, you really have to be very careful when you give loans against shares. But I think that's what happened. The competition for funds was so high because there was so much froth and so much, excitement and everything, that everybody's going after the business of startups, and not just having the business of startups is one thing, but then you can do business with the founders. Once they cash out through the IPO, you can manage their private wealth. So there's all of that stuff that comes with it, and that's unfortunately what most banks always, the trap that banks fall into is that the banks, they become very, very tolerant with risk, and then they blow up. So we have to punish that. Investors should be punished. Investors should do it's the job of investors to analyze this and understand this very well. It is our job as depositors to put the money there and do other things. We are not supposed to analyze the banks. Even for us, we have our money with a certain broker. I don't need to mention names. That broker's shares are also under pressure, like everybody else. And quite frankly, we can't do due diligence on it. We choose one of the big brokers in the United States, trillions of dollars on the balance sheet. I'm not going to go do due diligence now for 6 months just to know if I should put my money there. So what we have is we have the money here. We have some runaway money somewhere else just in case. Not just, by the way, if things go bankrupt here, but also if, let's say, the U.S. government goes after us, if they all of a sudden come up with some taxes and all of that kind of stuff. So to summarize, this financial situation, from our point of view, it's actually like everything else. It's always a good thing because I think it's going to take the froth out of the system, but it has to be handled very delicately. And I think it's the job of the regulators, in particular the Federal Reserve. Now the Federal Reserve has to show up. If there's one reason why the Federal Reserve exists, it is actually to prevent calamities of the magnitude that could happen if one bank goes bust and then everything else collapses with it. The fact that banks go bust is okay. They can make bad decisions. It happens when banks take too much risk, particularly with startups. This is what happened with Silicon Valley Bank. They gave loans against shares to startup founders. That is not something banks should be doing because they don't understand the startup business the same way that VCs don't understand it. Nobody quite understands how startups evolve. Once they evolve, once they go public, once they do well, once there's cash flow, you can then become a little bit more comfortable with the company. But before that, it is absolutely inconceivable. So it's okay to punish investors so they learn. By the way, I'm sorry, I forgot about the maturity risk, which is a whole other issue, which I just want to put this in here. So what a lot of banks are dealing with right now is the following. They take deposits and then they take the money and they buy treasuries. The maturity risk is the following. If you buy a 10-year treasury, you will actually not lose money, meaning it's a risk-free bond. You will get your yield and the money back. However, there's a maturity risk, which is if your deposit is, let's say, immediate, meaning you can pull your money anytime, and you have a 10-year treasury that you bought with that money, well, there's a risk, of course. But if I want my money back now, you have to sell the treasury. And if the treasury lost in value, you will lose money. So that's maturity risk. A lot of banks are exposed to that kind of risk, and we have to deal with that as investors and banks. And there's certainly a risk that the federal regulators have to be looking at, because a lot of banks have that risk because the treasury market collapsed. So there is definitely probably, I would say, there is a lingering, this Silicon Valley Bank would be the canary in the coal mine for much bigger problems to come up. And I think the solution to these problems will be what's called a shadow QE, which will be that, again, the depositors have to be made well, and the treasuries will end up in the end of the Federal Reserve balance sheet. So it's kind of, that's why it's called shadow QE. So again, sorry to put that into the summary, but again, to summary again, the three main reasons why banks are in trouble is generally bad credit decisions, shenanigans such as giving credit against shares of startups, which is very, very bad. And then third, the maturity risk. I think all of these risks are real. They should concern investors, but the depositors and the people who have money with banks and brokerages and so forth, they have to be made well by the regulators. That is the main job, and the financial system should be able to function with some bankruptcies here and there. That's fine. Banks go down, but overall the contagion has to be contained, and this is the main job of the regulators. Thank you.